Welcome to NBFC Podcast by Aumyaa Consultancy, where we decode real-world regulatory challenges faced by financial institutions every day in the country. I'm Harshita Sood, and today we are going to tackle the problem of the rapidly evolving RBI compliance landscape. If you run advice or audit an NBFC, you cannot afford to miss what has happened in the last 18 months. Joining me today is Ms. Ayushi Aggarwal, partner at Aumyaa Consultancy, with more than 10 years of experience in NBFC regulation, governance, and compliance. Welcome to the show.
Thank you, Harshita.
So, before we get into the specifics, how would you describe the shift in RBI's regulatory posture towards NBFCs over the last 3 years? Is this tightening, a maturing, or something else entirely?
What I understood in my journey, my professional journey, and with my experience, that RBI is more proactive than reactive nowadays. RBI is issuing AI governance, digital lending governance, and privacy governance. All of this shows a shift changes. It's not an incremental, shift from the RBI point of view. Now the RBI is also understanding that compliance is not only related to the board governance or the board responsibility. It is more about the risk assessment. It's more about like implementation of the policy and the procedure. So that change actually not coming from the regulator. It's coming from the leadership mindset also. Now the leaders also thinking compliance is not only a burden, it's not an expensive tool, it's also a strategic investment for their organization. So that's the change that both are combining together, regulator and the management. That's how our ecosystem is now building the compliance culture into the world.
The SBR framework has been in force since October 2022, but practitioners say the classification transition, especially from middle to upper layer, is far more operationally disruptive than expected. What are the practical realities that NBFCs are struggling with today?
So yes, the change is new for the base layer, especially when you cross the threshold 1000 crore of asset size, then base layer turn into middle layer. And then the corporate governance regulation become more wider in their scope. But the question arises on their strength, on their compliance department's strength, because you are not prepared for the 4 or the 5 people with a good skill set of NBFC experienced person in the team. You have to build it all together. And if you talk about the upper layer, that's a dramatic or change, I would say, because you have to constitute the committees, you have a deep level of governance is required, a huge level of assessments are required. So that's not a single thing that you can just do overnight. You have to prepare in advance. You have to see your projection timely basis, and you have to prepare in terms of your numbers also, so that you can build your organization strength well.
Most coverage focuses on upper and middle layer NBFCs, but there are over 9,000 registered NBFCs. The vast majority are base layer entities. What compliance obligations are base layer NBFCs sleepwalking on right now?
For the base layer, I would say some of the traps which are underappreciated for them, because if you know by the law, by March 2027, they should have a net own fund of 10 crore rupees. By the March 2026, we just passed on, they should have an NPL regulation. 90 days is standard for them. And for the governance direction, if we talk about the governance direction, it talks about there should be a minimum one director that should have experience of bank or an NBFC. So that is not so easy for a base layer, which is a very small in size, and they are contributor to our ecosystem. They are contributing to the society, but they are not ready for this, and maybe they have not prepared their system for the NPA 90 days standard, and for the net on fund, there is a capital pressure on them. So these changes I consider very underappreciated for them. And we all know in the May and June, almost 200 NBFC got their license got cancelled by the RBI, and majority was in Base Layer NBFC, registered in West Bengal. So these are the pressure RBI is putting on Base Layer also in terms of governance, and this is something we need to talk about and we need to think about it, that how they are going to run in the future for a long time.
November 2025 saw RBI issue India's first standalone governance framework for NBFCs. Historically, governance norms were scattered across multiple master directions. Why does consolidation matter? And what practically required for NBFCs?
After 28 November 2025, when RBI consolidated the direction, they have issued a separate corporate governance direction applicable on NBFC. Before that, it was part of the scale-based master direction. And when something is buried under one direction, it is considered as a sub-item. So it shows that how much RBI is putting pressure on the governance direction. They are more focused on the constitutions of the committee, not on just a paper, but on the in practicality also. They are not just saying that you just need to have one board member of experience of an NBFC or a bank. They are also capping a limit on independent director. At the same time, they can be just an independent director of 3 NBFC or a bank. So they are putting their effort so that a company can comply with, so that company can also, and the board of director can also think corporate governance is just not a matter of the paperwork, it's just not a matter of the tick box, it's a matter of compliant in a true letter and spirit.
The governance directions require NBFCs to appoint a chief compliance officer and a chief risk officer. But in practice, many NBFCs have the titles without the independence. What makes an effective CCO or CRO? And what does RBI actually look for during supervision?
It's actually quite funny that a company considers CCO designation and the CRO designation as a nameplate, but they are not. RBI expectation is something else. RBI considers CRO and the CCO at the top level. The risk register, the risk assessment, the conversation with the board member should directly come from the CRO. CCO is not a junior person who is just getting the notification and just complying with the notification of the RBI. CCO is the one person who is setting up the compliance culture in the company, who is taking after all compliances, be it with respect to the statutory compliances, with respect to the RBI compliances, SEBI compliances, who is taking over all the norms in their hand. If you will see the past trend, there is a penal action from the RBI with respect to violation of the corporate governance norms. When you change the director without the prior approval of RBI, when you acquire more than 26% of control without their approval, or there is a compensation deferral violation. All of these things are basically teaching us and telling us that you have to just not see the standard and the norms on a paper. They are actually reading our board minutes also. They are saying whether you are passing the resolution or you are actually practically applying those resolution in the company. So you have to prepare in advance what RBI is going to ask next. So whatever you are doing, just do in a true letter and spirit.
KFS is mandatory for all retail and MSME loans, but enforcement has revealed a gap. Many NBFCs are issuing KFS at dispersal, not at the offer stage. What is the practical difference and why does it matter?
So to answer this question, I would like to ask you, Harshita. You go for a shopping, right? And when you want to purchase a top or a jeans or something, you always check the price tag of that particular thing, that particular product. So if I tell you that you purchase these things, you purchase the jeans or the top, and I will tell you the price tag after your purchase. So how you will feel about it?
I would be angry with the...
Yes, you will be angry and there is a break of the trust, and you will think that it does not comply with your pocket.
Yeah.
And maybe so that's how KFS work in a lending company. KFS is nothing but your APR, your processing charges, your cost, your interest rate of interest, your repayment schedule. When the customer go to the bank or an NBFC, you have to tell them the terms and condition of the loan in advance before they are accepting the loan, before they are signing the contract, before the disbursement. You have to straightforward tell them at the stage of the offer. So how you can do this? You can build your system like a KFS is going at the time of the offer stage. It's not at the stage of the disbursement or after the at the time of the signing of the contract. Your process should be built like this. It generates the KFS automatically when the customer is reaching out to you, when customer is showing the interest to you and making an offer acceptance. So this is something KFS, and violation of this rule is not acceptable to RBI. Anything if you charge after the issuing of the KFS and the customer has accepted and you have not mentioned in the KFS, that's straightforward a violation of the law.
RBI has made clear that the NBFC, not the LSP, is accountable for the entire customer journey in digital lending. But NBFCs often lack real-time visibility into what their LSPs are doing. How do you build meaningful oversight without becoming the operational arm of a fintech?
Harshita, you also heard this thing while you were studying, that principal is always liable for the act of the agent. Same goes to the RE and the LSP relationship. Your LSP is doing whatever your LSP is doing. You always be accountable. You always be responsible for the act of the LSP, right? And RBI is not thinking that you bind contractual relationship with the LSP and then you think that you have a control over LSP. No, contractual relationship are good. You should have a agreement with your LSP, enforceable agreement with your LSP. But RBI is thinking more about it. You should have a API integration with your LSP. A live monitoring should be there, so that you also know that at what stage KFS is going, whether they are getting the customer consent or not, whether funds are not rerouting. So all of these things are expectation of the RBI from the guideline, from the digital lending guidelines, and you should always have a LSP due diligence framework at the time of the onboarding, at the time of the not only onboarding but periodic due diligence should be there to assess whether they are credit worthy, whether they are transparent, or whether they have financial capability to run the business that you want them to do. So this is the relationship, and this is the thing. That's the expectation from the law also. That's the expectation from from the management also.
The RBI NBFC Managing Risks Outsourcing Directions 2025 state explicitly that the board bears ultimate responsibility for all outsourcing arrangements. What does that mean operationally for an NBFC that outsources its IT, collections, and KYC?
So first of all, I would like to say that outsourcing arrangement is not a procurement department thing. It's a board level activity. Board has to approve your outsourcing policy. Board has to see the risk assessment procedure, whether the company has done annual or a half-year risk assessment of their outsourcing arrangement, whether the company has the MIS containing all your outsourcing arrangement, and then categorize into material, non-material, and then classify them into the different level of risk, what level of risk your outsourcing arrangement carries. So a central record is also required to be placed before the risk management committee or an outsourcing committee, whatever you have constituted. So it is rightly said, your RE, your regulated entity, the NBFC is accountable for the third party action, as we have discussed earlier also. Same goes to the principal and the agent and RE with the LSP, and same, it's all driving from the outsourcing direction only. LSP are also governed by the outsourcing direction only. The main important aspect here is your outsourcing agreement. There are some aspects are mentioned by the RBI that has to be part of your outsourcing agreement whenever you are having a service provider relationship with third party, and there is a requirement of the exit provision that has to be that has to be implemented, and that has to be think through at the time of onboarding of your service provider, because this is something can shape your organization business operation, and so that you always have to be prepared for the second or the third service provider in case he backed out. So that's the outsourcing arrangement understanding for me.
Okay, so final question, and we want a real answer, not a diplomatic one. If you could change one thing, regulatory, structural, or cultural, that would improve compliance quality across the NBFC sector right now, what would it be?
As per me, I think board accountability should be more enforceable and visible, because currently also board members are not aware what is happening in their organization, what is coming to their table as a resolution, for approval. So they must be more aware than the other stakeholder. What the resolutions say and what is actually happening in the organization are the two different things. So the board member has to act now. They have to they have to ask the question why this matter is coming to them, why their approval is required, what is actually happening in the organization. Just like a listed NBFC board member are doing, you should also other NBFC board member also consider their company the same way, and they should also be feel accountable for the action of the stakeholder, for the action of the organization. Not the turnover, or not only the turnover and the profit are important for the board member. I think the sustainability, the sustainable business is also important nowadays, and the digital world is a more important thing that we all are talking about, and the different podiums. So I would say their responsibility are much more bigger than the grounded person, than the executor. So as it is always saying that if something you want to change, it always need to come from the top. So their responsibility, their accountability, and their questions matters a lot to everyone. That's how we can change the model of our organization. That's how we can build the compliance culture in the company.
Thank you, ma'am. This was really insightful. We're really glad to have you.
Thank you so much. Thank you so much.